It's Friday, 2nd of May, and this is your Capital Economics Weekly Briefing. Coming up, why oil's bad recent price performance could get much worse as Saudi signals it could turn on the taps. But first, Group Chief Economist Neil Shearing is with me once again to rake over another eventful 5 days in macro and markets. Hi Neil, how you going?
Good, David. How are you?
Yeah, good. I just described it as an eventful 5 days, but compared to the standard of recent...
It's got quieter and the sun is shining in London. All told, a better week, I would say.
Yeah, maybe where you are, the sun's shining. Anyway, it is the end of the week. It's about 2 o'clock London time, and we've just had the US April payrolls report. Now, this is the first one to cover the post-Liberation Day period. What are the big takeaways?
The big takeaway, I think, is that the US labour market is still in pretty good shape. Obviously, the focus is on the headline gain in non-farm payrolls, 177,000. Pretty good. A labour market that is still, as I say, in good shape. There was a bit of a downward revision to the previous month's figures, which took some of the shine off the report. But by and large, when you look through the detail, it's a pretty good report. Unemployment rate unchanged at 4.2%. Not much sign here or evidence here of the impact of DOGE on federal employees and federal employment. But as we've argued before in our research, that's because often those that have left the federal government remain on the payrolls for a while. So it's going to take a while for that to show up in the actual payrolls figures. Headline figure, pretty encouraging. Breakdown positive. Unemployment flat. Nothing here to worry policymakers, particularly those at the Fed. I don't think it's going to be pushing the Fed into the rate cuts that the president wants.
We'll get onto that because the Fed is meeting, as you say, in the coming week. But more broadly, what does this say about the impact of higher tariffs? Everyone's scouring around for signals. We know that tariffs are bad, but the data haven't really captured that yet, have they? So everyone's scouring around for signals of this negative impact. Where is it?
Quite. One bit of caution that the reporting period for this report covers I think the week after the Liberation Day tariffs were announced. So it may be that it's too soon to fully capture the effects of that announcement. But you're right that it's very difficult to see the effects of this in the data. If you remember a few podcasts ago, we were talking about the effect of uncertainty on economies and the idea that the massive amounts of uncertainty generated by tariff announcements and their rollbacks was causing firms to either pause capital expenditure or consumers to pull back on expenditure themselves. When you look at the breakdown of the Q1 GDP data, for example, in the US, actually business investment was really strong, driven by investment particularly in software and IT. So more of that AI story running through the Q1 data there. So not much evidence that uncertainty is causing activity to cool yet. Not much evidence that it's causing firms to pull back on employment and the labour market's cracking. Some concern, I think, certainly amongst the financial market commentariat and amongst sell-side analysts about the collapse in things like shipments to the US and port berth bookings in the US, which have fallen off a cliff in the past week or so. But I think some important context there is that there's been a surge in shipments to the US in the previous months. Indeed, that's part of what we saw in the Q1 GDP data. That's why we got a negative print, was this big surge in imports. And so firms have been trying to front run tariffs, build up some inventory. Indeed, if you look at sales to inventory ratios, they're not at an alarming level. So I wouldn't read too much at this stage into the big drop off in data like port berth bookings and shipments to the US. So you're right, not much evidence yet in the data that we're seeing an effect of tariffs, but it might just be that this is to come. And in particular, in the inflation data, we've never expected to see much of an effect of tariffs until perhaps the data for May or even June. So it might be not until June or July that we start to really see this start to show up in some of the data.
With that caveat, though, the PMIs and other surveys have been reflecting the negative impact of these tariffs. And perhaps they're sentiment driven in as much as they are just at the end of the day surveys. They're people on the phone or on computer asking businesses about conditions. But how worrying have they been, particularly the ones that have been coming out of Asia, in terms of what they signal about how the hard data is going to wind up?
Yes, you're right. The surveys that we've had over the past week or so do look a bit concerning. But again, some health warnings there. If you look at the consumer confidence numbers, we've spoken before about how the relationship between consumer confidence and consumer spending in the US in particular has weakened substantially. And the PMIs too, and for that matter, the ISM have not been a great leading indicator of GDP growth in the US in recent years. So possibly driven more by sentiment than actual conditions on the ground. But you're right that at face value, these surveys do look pretty concerning. In China, when we look at both the official and the unofficial PMIs, they look concerning too. They look troubling too. But again, we saw this pattern in the previous trade war with the PMIs weakening back then in 2018, 2019, but the real economy not weakening to the same extent. So not saying there's nothing to see here. This could well materialize, but there is history. There's a pattern here of the survey data overreacting to shocks like tariffs and the hard data being a bit more resilient. And it could be that's just playing out once again. But we'll know one way or the other over the coming weeks and months. We're building a dashboard as we speak, tracking global trade around the globe through the different parts of the trade cycle with high frequency data. So we'll have more to say on this in the coming days.
Give me a sense of what you make of the market reaction to all this, because I see S&P futures had a very positive reaction to this payrolls report. And if it all holds, then the S&P is on course to erase post-Liberation Day losses. And it also comes after these reports we've been getting from Beijing that the government may finally be ready to talk to the US to de-escalate. But there is a long road ahead, right, in terms of getting trade deals done that would bring tariffs down substantially enough, certainly in China's case, from extraordinarily high levels. So do you think that markets have swung too far in the other direction and actually that now they're being a bit too complacent about this tariffs hit?
I think it's quite difficult to work out exactly what markets are expecting at the moment. So if you look at the equity market, certainly you're right. If the S&P moves in line with futures when it opens in a few minutes' time, then it would be on course to erase those losses since the Liberation Day tariffs of April the 2nd. And that would suggest, I think, that both the market is anticipating further climb down on tariffs, but also that the economic damage caused by tariffs, perhaps because there has been a climb down, is limited. Yet if you look at the bond market, it's telling you a rather different story, I think. If you look at the bond market, we've got almost 4 25 basis point cuts priced into the market now. Yes, yields have come down, but that's been principally because of, as I say, the rate expectations have been grinding low. The term premium at the 10-year part of the curve has remained pretty steady around 70 basis points or so. So as rate expectations coming down, and that would appear to be telling you that the market's becoming a bit more worried about the economic outlook because it's anticipating the Fed's going to have to step in and cut interest rates. So conflicting signals from the market at this stage. I think, now where do we go from here? I think a lot hinges on whether some of the warm words around tariffs actually start to translate into action. You mentioned China. Finding a pathway to some kind of climb down and deal there is going to be extremely difficult to do, I think, but it is possible, but it will be difficult. It will be easier to do deals between the US and traditional allies like Japan, India, the UK, Korea. Those, I think, will be the countries that will form a litmus test for others, really. So if the US is able to come to some kind of deal, I'm not talking a full trade deal, of course those take years to negotiate. I'm talking about some kind of memorandum of understanding specifically on tariffs and maybe other countries agreeing purchases of US goods. But if they can do some form of memorandum of understanding or kind of mini deal with those friendly countries, then I think that will provide a bit of reassurance to markets that that some of these warm words will be backed up by action. But as I say, I think more warm words at this stage, I don't think is necessarily going to give the market another leg up. It's going to have to be backed up by some policy action.
Okay, let's turn to the coming week's big monetary policy meetings. The Fed on Tuesday, Wednesday, Bank of England on Thursday. Of the two, presumably the Fed's got a much more challenging decision to make, not least because whatever they come up with is going to be very heavily scrutinized by the man in the White House.
Absolutely. The Fed in an incredibly difficult position, facing what I think will be a stagflationary shock hitting the US economy, not necessarily a major shock, but a stagflationary one. Tariffs will, I think eventually, we've just been talking about how tariffs have not had a major impact on the the data so far, but I think they will start to weigh on activity going forward to some extent, and to push up inflation too. So we have core PCE inflation getting closer to 4% later this year. So a mild stagflationary shock about to hit the US economy. And because that puts the Fed in a rather difficult position, I think, because the economy is not necessarily collapsing into recession, or at least in our view, is not going to be collapsing into recession, because the tariffs get diluted, rolled back, and ultimately the 90-day pause gets extended. And so you don't get these really punitive tariffs. You just get a slowdown, therefore, in the US economy into 1% growth or so, rather than a collapse into recession. In that case, there's less pressure on the Fed to start lowering interest rates, and they'll perhaps put a bit more weight on the fact that core inflation is rising, if only temporarily, because of tariffs. And so you get this paradoxical sense that the milder the tariff shock, then the less likely the Fed is to do what Trump wants them to do, which is to say, cut interest rates. So my sense is that the market's got a bit ahead of itself in the US in terms of pricing in interest rate cuts over the next 6 months or so, and that unless the real economy really does start to weaken, the Fed will be a bit slower to cut interest rates. It may not start to get going perhaps until next year. Now, the Bank of England is in an entirely different situation, in part because there's no inflationary shock coming from tariffs. If anything, tariffs for the UK are in fact disinflationary. So with the real economy looking like it's had a decent start to the year, but the survey suggesting growth is going to be slower in the UK in Q2 as the effect of some of the business taxes that were announced in the budget start to take effect, then I think we get a weakening economy in Q2. You get the potential, added to that, the potential effect of tariffs imposed by the US, the global economy starting to moderate. Of course, you've got to slow too. And you've got a strong pound. I think all of this adds up to further rate cuts by the Bank of England. So almost certainly another 25 basis point cut when the Bank of England meets in the coming week. That would take rates to 4.25%. We're forecasting a fall to 3.5%. Now, what happens beyond that? There's been an enormous shift in market pricing for UK rates over the past couple of months or so, principally since the tariff announcements, actually. And we've moved from a position where we have been below the market in terms of pricing for UK rates to now perhaps a bit more hawkish. So both the market and ourselves see rates troughing somewhere in the UK, troughing somewhere around 3.5%, but the market gets there a bit quicker. And the reason for that is that we think there's perhaps a bit more inflation in the system over the next couple of months or so as the effects of high utility prices and so on and so forth work through. But I think, take a step back, much easier job for the Bank of England in terms of policy decisions, and it's pretty unequivocally pointing to cutting rates at this stage.
And the idea that tariffs are disinflationary, because there was debate in the Bank of England, there was debate in the ECB as well, initially at least, as to whether tariffs would be inflationary or disinflationary. It sounds from what you're saying that officials have concluded they will be disinflationary, and that's the right call to make.
I think it depends on what side of the tariff you find yourself, right? If you're in the country that has imposed the tariff, then it's likely that it's going to push up the prices of imported goods in that country, and therefore that will contribute to higher inflation. So if you're the US, tariffs are inflationary. If you're in the UK and the UK government does not retaliate to tariffs from the US, and that's the critical point, then the only effect of tariffs really is to push up prices in the US and perhaps diminish US demand for UK exports. Now, the former might be mildly inflationary for the UK because it raises global inflation, but the latter is mildly disinflationary. So overall, it's a wash, and I think probably mildly disinflationary at the margin, but it's not going to be a big influence on policy in the UK, I think, if we do get this kind of more modest imposition of tariffs.
Neil Shearing on the economic impact of tariffs, where it'll show up in the data, and how the Fed and Bank of England will play it at their meetings in the coming week. Look out for our written responses to those meetings and join the team on a drop-in, that's one of our short-form online briefings, at 2 p.m. London, 9 a.m. New York on Thursday to ask questions and hear about what's next for the Fed, Bank of England and the ECB. Our central bank hub has our forecast for policy rates 2 years out. I will post that and details of the drop-in in the show notes. We've also got a briefing this coming week on which economies stand to gain market share if Chinese goods remain effectively shut out of the US. The team will be taking questions and highlighting key takeaways on their recent analysis, looking at the potential opportunities of economies from Mexico to India. I'll add the details of that briefing to the notes along with the underlying report. And remember, if you want access to all our drop-ins and all of our written analysis, as well as a growing suite of data solutions, then check out CE Essential and CE Advance, our all-access packages. Speak to your account manager and we will get you set up pronto. And if you haven't got your very own Capital Economics account manager and want one, it's easy. Pop us a line at sales@capitaleconomics.com and we'll do the rest. Now, oil prices have slumped since Trump's Liberation Day announcement. They're down nearly 20%, but they've been falling all year in part because of worries that the trade war will hammer global demand. There's a big supply story here too. For more than 6 months, our commodities team has been warning clients that Saudi Arabia could stop supporting the market with cuts and instead turn on the taps. Developments this past week suggest that that's looking more likely, and if it did happen, then the bad year for oil prices could get much, much worse. Ahead of a key OPEC Plus meeting this Monday, David Oxley, our Chief Commodities and Climate Economist, spoke to Olivia Cross, who's an economist on our Commodities and Climate desk. Their conversation was recorded on Thursday around midday London time, and here it is with Olivia talking about what's been happening to prices.
Obviously, it was the Liberation Day tariff announcement that triggered the big kickdown in prices. In the days after that, we saw Brent fall down to just below $63 per barrel. And that was based on fears of what's going to happen to global trade, what's going to happen to global industry, fears of recession, etc. That seemed to calm down a little bit after Trump announced the 90-day pause on reciprocal tariffs. And we saw a little bit of a rally in oil prices. Obviously, that was interrupted by some of these supply dynamics, which we'll maybe dig into a little bit later. Taking a bit of a step back, the bigger picture is that even before all of the tariff announcements, even before the latest drop in oil prices, they had been stuck in this kind of corridor of between kind of $70 and $75 per barrel. And the reason for that was really the fundamental weakness in demand that we'd seen even before all of this. There's a couple of things coming into play there. You would have expected in the US with GDP growth really quite strong over the past year that oil demand also would have been. That's not necessarily been the case. There's been a bit of a divergence between the two, and oil demand in the US has been pretty stagnant. And actually, whatever your assumptions are about whether the US could avoid a recession or not, even before that, it looked like oil demand was going to be pretty stagnant or maybe even fall a bit this year. And then if you turn to one of the other largest oil consumers, China, the big story there over the past year has really been the structural weakness in oil demand. We've seen the rollout of EVs being much more rapid than anyone had expected there. And that's been a long-term drag on oil demand. And the cyclical picture hasn't been that strong either. So you have two largest oil consumers. Oil demand's pretty weak there. And I think that kind of fundamental weakness is one of the reasons why it's been so challenging for OPEC. It's been a challenging environment for them to operate in and to be able to lend some support to prices because that kind of fundamental strength just isn't there.
Yeah, so what you're painting a picture of even before this uncertainty, oil demand was not a picture of health. But this big dose of uncertainty that perhaps was at the height during the sort of tariff chaos, that's receded a little bit. As you mentioned, turning to OPEC, it perhaps for the health of oil watchers, it has not been really that helpful for OPEC to dial in a huge amount of uncertainty about its intentions, what it wants to do in terms of bringing some of the oil it has currently in the spare capacity back to the market. Can you help us understand what's going on with OPEC, both in terms of its overall production plans, but also some of the tensions that are clearly simmering under the surface?
Yeah, as you say, there's this kind of long-run fundamental challenge within OPEC where they're balancing its two strategic aims of getting oil out of the ground and maintaining its market share, but at the same time supporting prices, particularly in the current demand environment. And it feels like over the past couple of months, the focus of OPEC has shifted a little bit from supporting oil prices, now leaning more towards boosting output and getting oil out of the ground while the demand is there. And perhaps that's because simply over the past 6 months or so, that strategy of trying to support oil prices just hasn't worked, even though they've taken these voluntary output cuts, even though they've tried to hold members to their quotas. We haven't really seen that strategy worked. And maybe we're just getting to the point where some members feel that this strategy isn't working for them. They need to change tack a little bit. I think you alluded to some of the tensions within OPEC, and I think a core theme of that has been overproduction and a failure for some producers to stick to their quotas. The country that's been in the news quite a lot recently has been Kazakhstan, one of these serial overproducers. And I think we've seen increasingly a willingness from OPEC Plus and Saudi to push back and tighten the screws a little bit.
Over the past week, it certainly seems that some of these tensions within the group, as you said, between the countries who have been trying to prop up prices by curtailing demand, namely Saudi Arabia, to punish some of these serial overproducers, as you say, Kazakhstan. It feels like this is coming to a head. This is something we have been pointing to for a long time now. Possibly an odd time for this dirty laundry to be aired in public against such a backdrop of demand uncertainty. One might have expected OPEC to keep its powder dry as such, but yeah, it certainly seems that these long-standing tensions are coming to the fore. It's a tricky question, but help us understand what this all means for the oil price. Big uncertainty over demand and supply. How do you see things playing out?
As you say, there's a huge amount of uncertainty at the moment. And I think there's risks on both sides. I think there is an argument that in the near term, there could be a little bit of an upside to oil prices, depending on what happens on the tariff front and the demand side. Our base case for tariffs is that we do expect that tariffs on China might be rolled back a little bit, perhaps towards the kind of 60% tariff rate. And we do expect that this lower tariff rate for other economies of around 10%, that's probably where they'll end up, either through the pause on reciprocal tariffs being extended or trade deals being struck. So I think if that doesn't necessarily seem like it's fully priced into the market, or if we get a little bit more certainty on that, I think we could see a little bit of upside for oil prices in the short term. But actually, I think the bigger trend will be what's happening with OPEC. That will be the bigger driver of prices over the long term. And, as you've mentioned, we've been warning about this risk that OPEC Plus just does, get frustrated with its current strategy, change tack, and either bring output back much more quickly than was initially expected, or just even goes to a full kind of flood the market type scenario. And I think that if that happened, that would obviously be a big downside risk for prices. And I think something like that would certainly offset any kind of news on the demand front, on the tariff front.
Olivia Cross there with David Oxley on the oil price outlook. The team will be doing a drop-in this coming Wednesday to answer your questions about the OPEC meeting and the price outlook, and to preview Donald Trump's visit to the Gulf from the 13th of May. Again, check the show notes for details of the briefing. But that's it for this week. Neil and I will be back next week with more from the global economy and markets, including a review of what Jerome Powell and co. decided and whether Trump could resist hitting social media to weigh in with his opinion. But until then, goodbye.